Think about this for a second. The richest, most connected, earliest to know people on the planet are pulling $47 billion out of US stocks in a single quarter. But that money isn't going into Chinese stocks, Europe, real estate, or crypto. It's going into physical gold, into a vault as real metal in Hong Kong, Singapore, and Switzerland. And here's the real question. Is this just portfolio rebalancing by wealthy people? Or is this a direct repeat of the silent signal we saw in 2007? Today, I'm not going to sell you a conspiracy. I'm going to walk you through one claim. Smart money is leaving the US and running into gold. And if that pattern is real, this isn't a trading opportunity. It's a five-alarm fire. This video is not financial advice. I'm not a financial advisor. But here's what I will do. I'll take the data, the logic, and the historical parallel being presented and lay it out in one clean line. And at the end, I'll make it clear what I would do if I were in your position. Why this isn't normal. Wealthy people moving money around is normal. They do it constantly. Taxes change, country risk changes, portfolios get rebalanced, capital shifts between funds. But here are the three things that make this not normal. 1. The size. $47 billion is not small money. This isn't one family, this is a class-level move. 2. The direction. They aren't rotating into another risky asset. They're not selling stocks to buy different stocks. They're not jumping into crypto. They're not piling into real estate. They're moving into gold and specifically physical gold. 3. The timing. The claim is that this is happening while everyone still feels comfortable. Markets still look strong, headlines are still optimistic, and historically that combination is one of the most dangerous signals you can see. The core claim, US stocks sold, gold bought. Let's define the main claim clearly. In Q3 of 2025, there was $47 billion in net selling of US equities linked to Chinese investors. That money doesn't disappear. According to the claim, based on World Gold Council data, there was $47.2 billion in gold purchases in the same period. Here's how the breakdown is presented. Screen, three-part chart. Individuals, large-scale purchases of bars and coins. Institutions, gold ETFs and similar vehicles. Family offices, private vault storage / allocated physical gold. This isn't a story about a retail investor buying a gold necklace. This is a story about risk exit. Why should the American 401k investor care? Why should I care if Chinese billionaires bought gold? If your portfolio is heavily weighted toward the S&P 500, NASDAQ, or tech stocks, there's only one reason this wouldn't matter. That would be if this class of investors was usually wrong. But the claim being made is the opposite. These people see what the public only notices much later. And the issue isn't they want to profit. The issue is this. When this level of capital starts running from risk, the next wave often forces the market to sell. So the real danger isn't they sold $47 billion. The real danger is this question. If this is wave 1, do wave 2 and wave 3 follow? A $70 billion sentiment reversal in 12 months. The strength of this narrative isn't just the selling, it's the speed of the reversal. Here's what the situation is claiming. In Q3 of 2024, Chinese investors were net buyers of US equities, adding plus $23 billion. In Q3 of 2025, they flipped into net sellers, dumping minus $47 billion. So, in 12 months, from plus 23 to minus 47 leads to a total swing of about $70 billion. That's not we reduced risk a little, that's sentiment fully flipped. And this is where the psychological threshold hits. If capital that spent 40 years saying, we buy America even in crisis, suddenly shifts into, we're exiting permanently, then this isn't just news, it's a regime change signal. The 2007 parallel. Silent selling, then collapse. Now let me take you back to 2007. Back then, everything looked perfect. Housing was assumed to only go up. Mortgages were being packaged. They were being sold into pension funds. And the S&P 500 peaked in October 2007. But the claim is this: Chinese investors were quietly selling during that period. Based on Treasury data, there was allegedly $31 billion in net selling from Q4 2006 through Q2 2007. And then came the timeline. Screen, timeline. Summer 2007. Credit markets tighten. Bear Stearns starts showing cracks 2008. The crisis expands September 2008. Lehman collapses 2009. The bottom. And the message being delivered is simple. After Chinese capital started exiting, the system broke within 12 to 18 months. Here's the deadly lesson. Before markets peak, the signal isn't always in the headlines. Sometimes it's in capital flows. And back then, the media dismissed it as portfolio adjustment. So the question becomes, are we watching the same movie again? Because that's the entire point of this video. What do they see? 3 information advantages. The narrative explains early action by Chinese elites through 3 advantages. 1. Factory line data. Real-time demand. China produces much of what the West consumes. When orders slow down, the first place to feel it is the factory floor. You'll see that slowdown 6 months later in earnings reports. They see it the same day through cancellation emails. 2. Banking networks. Being on the other side of the trade. When credit quality begins to break down, counterparties see it first. You read rating reports, they see the collateral quality directly. 3. State capacity. Strategic data collection. The claim is that China monitors things like port traffic, warehouse activity, and trade flows to generate early signals. Not delayed macro indicators, real-time economic movement. Conclusion: not prediction, information. Now, this doesn't have to be 100% true to matter, but it's true in one key way. Early data advantage creates massive asymmetry in financial markets. 4 systemic risks driving this move in 2025. Now we get to the why now part. 4 systemic risks are presented. 1. AI infrastructure orders are slowing. The claim is that China's supply chain sits on the front line of AI infrastructure. Servers, power systems, cooling, components. If orders are slowing, future growth gets hit. The psychology here is critical. AI has been the biggest growth engine story of recent years. If the engine starts to stutter, valuation foundations shake. 2. U.S. debt dynamics. The narrative frames this as unsustainability through debt to GDP. The idea is simple. Debt grows, interest burden increases, flexibility collapses, and the currency comes under pressure. 3. Geopolitical risk. The threat of asset freezing or seizure. Using Russian asset freezes as the example, the fear is if the U.S. can weaponize financial assets, it can do the same to Chinese wealth. This matters because stocks are paper claims. Ownership depends on the system. If trust in the system declines, capital runs toward physical assets. 4. Reserve currency erosion/dollar risk. The claim is that falling dollar dominance and rising alternatives represent a structural shift. At that point, what matters isn't the percentage. It's the trend perception. When perception flips, big capital moves first. Why gold? Specifically, the narrative describes gold as the ultimate safe haven for 3 reasons. 1. No counterparty risk. When you buy stocks, you rely on everything: the company, regulation, the market, the currency, the exchange. With physical gold, you hold the metal. 2. Global acceptance: gold is recognized everywhere. Cross-border liquidity perception is extremely high. 3. Protection against inflation and currency erosion. Gold rises as a store of value when confidence in money systems weakens. That combination, especially in the triangle of geopolitical stress, debt pressure, and uncertainty, makes gold a logical escape asset. The capital flight happens in waves. Model. This is the most important part of the video. The claim is this doesn't happen overnight. It happens in waves. Wave 1. Smart money. Right now. Billionaires, family offices, sovereign capital. Quiet selling, shrinking exposure without breaking the market. Wave 2. Forced institutional selling. When markets drop, investors pull money from funds. Funds must sell equities to raise cash. That creates more declines, a spiral. Wave 3. Retail panic. At the end, when people can't take it anymore, capitulation selling happens at the bottom. The classic tragedy: people sell at the bottom and buy back at the top. The model says, if this is a fire, the smoke shows up in the smart money room first. The crowd smells it last. So what do we do with this? Principles: I'm not going to tell you to buy this or sell that. But this narrative forces a few hard principles. Measure concentration risk. Is your portfolio overly dependent on one country, one index, one theme? Take liquidity seriously. In a crisis, the most valuable asset is often cash, because when opportunity hits, cash gives you the ability to move. Understand hedging tools. Gold is one example, but the point isn't buy gold, like the point is, how does your portfolio behave in a crisis scenario? Durability over timing. Nobody can perfectly time tops and bottoms, but durability helps you survive even if you're wrong on timing. Let's summarize. This narrative says, in Q3 2025, Chinese elites pulled $47 billion out of U.S. equities and moved into physical gold. This may not be normal rebalancing, Yan, because the direction is clear. Risk off flight. And the historical parallel whispers something dangerous. Before a crash, the earliest warning signal often isn't in headlines, it's in capital flows. If you found this video informative, don't forget to hit the subscribe button.